John, the markets are pretty convinced today that they're going to get something from the Fed. What do you think they're going to do?
Well, at the very least, I think the Fed has to acknowledge at least a slightly worse economic outlook, worse economic data in the last few months. I think at the very least, they have to say that they stand ready to act if conditions don't improve. But I think there's a very decent chance that they're going to extend their Operation Twist program, where they're shifting their portfolio from short-term securities to long-term securities. They could potentially even move them into mortgage-backed securities. You know, they did the program last year, and I think one of the things that's going to weigh on them at this meeting today is that there wasn't a lot of cost. There wasn't a lot of backlash from people. There weren't inflationary repercussions. Here we are a year later, and inflation looks like it's settling down. So they could take out some insurance on a worsening economic outlook by extending that program. Now, of course, I don't know what's going to happen in that room today, but it seems like that's a pretty safe way for them to go.
Now, John, when you say there's not much cost, that's because through Operation Twist, as it's called, the Fed isn't actually expanding its balance sheet, so it's not seen as being potentially inflationary.
Well, it's interesting. It's really a political cost, because when they did QE2, when they did expand their balance sheet, they didn't think there was an inflationary risk to that either. They think they can manage all the money that they're putting into the financial system. But they got a lot of backlash when they did QE2. And they didn't get the backlash when they did Operation Twist. So, I think it's more the perceptions that they're creating, and I think that they probably feel that they could do an Operation Twist for a few more months and not worry people, not create an inflation expectation that they actually don't think is a problem right now in the first place.
John, it's interesting that you say there about the backlash and the perceptions, because, of course, this is sort of the last meeting when they're not really in the heat of the presidential race. I mean, they're going to meet again in August, but we're in convention season then. How much of a window do you think they are thinking they have now, and that if they're going to do something, they have to do it today?
I don't think that Ben Bernanke is going to feel. I mean, obviously, this is something that kind of looms over the meeting. You'll never see when the transcripts came out that they were tailoring, their decisions based on the election cycle. Frankly, Bernanke has about 18 more months left at the Fed. His term ends in 2014. I don't think he's going to want another one. I think at the end of the day, he's going to try to do what he thinks is best for the economy. He cares more about his legacy right now than attacks from Republicans. Having said that, it's probably more convenient for them. This is another reason to do Operation Twist today. They could extend it for another 6 or 7 months, get past the election cycle, and then spend some time looking at how the economy is doing and make decisions about whether they need to do any more next year. There's something to be said for that. I don't think it's a primary concern, but it's something that, might weigh in the back of their minds.